The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone. My name is Shiraz Khan. I'm the head of tax at Tamimi and Company in the Middle East and North Africa. For those who haven't heard about us, we're the largest law firm in the Middle East, and we have offices across all 6 GCC countries and also Egypt, Iraq, and Jordan. We also have a tax practice across the region as well, and we focus on all the countries in which we operate. The purpose of today's webinar is to actually talk about the introduction of corporate tax in the UAE. Of course, this represents a major change to the tax landscape here in the UAE, and obviously involves a lot of thinking from your side in terms of how you'd be impacted and what you need to do. So today's agenda is going to be talk about perhaps some of the drivers why corporate tax is being introduced in the UAE, and then give you an overview of the corporate tax regime here in the UAE, talk about what we know, what's been announced, what we don't know, and more importantly, what we expect to happen in areas where we don't know anything. And then finally, I'll be touching on what impact it's going to have on businesses in the UAE and what businesses should be doing now and going forward. And then we'll have a question and answers session in the end. Just a few housekeeping points. So the session is being recorded. We will share a recording after the session. The audience is muted. Please do submit questions via the chat function. I'll obviously try to address all the questions insofar as I can. If I cannot, then I'll try to respond to you by email. If you can't hear us, please make sure you're connected to your audio by clicking on the Communicate tab on the top of your screen and choose to either connect through your computer, audio, or phone. Now, in terms of the drivers behind the introduction of UAE corporate income tax here, before you understand the drivers, I think it's important to talk about the historical tax environment here in the UAE, how that's involved and how that's led to the introduction of corporate tax. Now, some of the historical, in terms of the historical tax environment, the UAE, as we all know, has historically had very low or limited taxes. It's a global business hub and also a regional business hub. And historically, it's had very limited corporate income tax at the Emirates level only. There's been a lot of free zones which have tax exemptions. There's been no personal income tax. And also there was no historically indirect taxes in the form of value-added tax. Of course, in 2014, 2015, there was a decline in the oil and gas prices. And that obviously prompted the discussion of the introduction of value-added tax in the region, and this was discussed at the regional level. And since then, a number of countries in the region, including the UAE, which is one of the first 2 countries along with Saudi to introduce value-added tax in 2018. The IMF had said at the time that, in terms of value-added tax, will result in the collection of tax revenues of around 2.5% of GDP. And of course, generally, tax in most countries, it generates revenue for the government. Historically, in the region, there's been a lot of oil and gas riches, but now the focus is to diversify away from hydrocarbon revenue and to fund the public expenditure through taxes. Now, in terms of VAT, while the driver was the reduction in oil and gas prices, for corporate tax is very, very different. If you want to understand why corporate tax has been introduced, you have to actually look at the global tax landscape. So it all started back in 2008, 2009, when there was a global recession. Many countries went into budget deficit, and they started to ask themselves the questions that how could we generate additional revenue? Now, tax obviously being the primary revenue generator for most countries became the focus. So back in around 2013, in order to address these budget deficit issues, the G20 countries approached the OECD and they said, look, how could we tackle this problem? Because at that time, many companies who were previously operating within a certain border in a particular country, they rapidly expanded, and there was the advent of globalization. And unfortunately, the tax rules lagged behind and weren't able to keep up to date. So the tax rules were widely regarded as out of date. And at that time, we had double tax agreements, the purpose of which was to eliminate double taxation, but these were being used by some multinationals to pay no tax at all. So a lot of multinationals, they were shifting profits from high tax countries to low tax countries, and therefore minimizing their tax burden. So this was an immediate area which needed to be addressed. And at that time, the OECD looked at this, and they came out with an action plan with 15 action points, which countries were encouraged to adopt. Now, the UAE is actually a BEPS inclusive member, so therefore it committed to implement 4 of these standards. But after this initial BEPS project, which stands for Base Erosion Profit Shifting project undertaken by the OECD, the G7 countries approached the OECD, and this project, initial BEPS project, evolved into a BEPS 2 project, which involved Pillar 1 and Pillar 2, 2 pillars. Pillar 1 dealt with the allocation of tax rights, and Pillar 2 dealt with a global minimum tax, which is being discussed at the 15% rate. So essentially, what happened was that, some time ago, G7 countries had a meeting, and they approved of a global minimum tax of 15%. And then G20 countries had a meeting, and they also further approved the global minimum tax. And then this has been increasingly adopted by BEPS inclusive members. And currently, it's over 100 BEPS inclusive members, including the UAE. Now, when this global minimum tax was proposed, the UAE essentially had a choice, because under this Pillar 2, if you're taxed under a rate of 15%, if your effective tax rate is below 15%, then you may potentially be taxed in other countries. So therefore, the UAE was faced with a choice. Does it stand still and let UAE companies who are not taxed here be taxed in other countries, or does it introduce a corporate tax and collect the tax revenue from these companies rather than let this revenue be taxed in other countries? Obviously, one of the historical benefits of being here in the UAE, there was a low tax environment. So these are some of the drivers behind why corporate tax is being introduced. And of course, we saw earlier on that the UAE is increasingly adopting international standards. They introduced substance regulations in line with the requirements of the EU in order to come off the blacklist at the time, because there was some pressure for countries that had no tax to have substance regulations requiring companies who are based here in the UAE, because it has no effectively corporate taxation, to require companies to have substance before they operate here. Now, in terms of the legislative framework, before I go on to that, I just wanted to update you in terms of where we are right now. So as most of you are aware, in January, there was an announcement by the Ministry of Finance that corporate tax would be introduced. That announcement effectively was no more than an announcement of the policy decisions the UAE had made on key aspects. And there was no further detail provided. Subsequently, there was a FAQ published by the Ministry of Finance, which contains some additional detail. But at this stage, no draft legislation, whether the law or the regulations, have been published. The expectation is that in the next few months, possibly by the middle of the year, further guidance will be made available. So now that corporate tax is coming in, it of course needs to be administered by a tax authority. The Federal Tax Authority was established by legislation in 2016, and it's responsible for the administration, enforcement, and collection of federal taxes. And the first 2 federal taxes in 2018 were, of course, excise tax, which was introduced in October 2017, and also value-added tax, which was introduced in 2018. Now, the corporate tax will be the 3rd federal tax, which will be under the responsibility of the Federal Tax Authority. Now, we also have double tax treaties. It's important to note that double tax treaties, they're not a law or legislation, they're agreements between countries. So the UAE has entered into more than 100 double tax treaties, under which it's agreed with other countries on how tax rights will be allocated between the countries, with a view to minimizing and avoiding double taxation. So the double tax treaties are actually the responsibility of the Ministry of Finance. Now, once the legislation is introduced, it's probably likely, based on the trend that we've seen, there's going to be a law and there's going to be regulations. Normally, the law sets out some basic rules on corporate tax, and the regulations go into further detail on the application of these rules. And we also have the tax procedures law and regulations. Now, although there'll be some specific procedures mentioned in the corporate tax law and regulations, the general procedures are for all taxes, federal taxes, which are administered by the Federal Tax Authority, are set out in the tax procedures law and regulations. So you'll find details in relation to registration for tax, filing of a tax return, payment of tax, issuance of assessments, tax audits, and also the penalty regime as well. Now, for example, it may be that the corporate tax law contains some more details. So the tax procedures law will only tell you when you need to file a return within a certain period, within a periodic basis. Now, the corporate tax law will define the periods in more detail. Even when the laws and regulations are issued, obviously, corporate tax in the UAE is going to be very, very new, and over time, things will develop. More guidance will be issued by the tax authorities. As time goes on, the tax authorities' practice will develop, and its interpretation on different aspects will be developed over time. There's also the possibility of obtaining rulings, which are called clarifications, from the tax authority on their interpretation of the tax law. And of course, when disputes start to happen and then they're contested before the courts, then the courts will issue judgments, and then we'll have some level of precedent on which to rely on. But this will all take time. Of course, the tax has not yet been introduced. Now, in terms of an overview of the corporate income tax regime, I think a lot of clients ask the question, what is corporate tax, and why are we paying or are going to have to pay an additional tax? We're already paying VAT. They don't understand the difference between corporate tax and value-added tax. I think the key difference between corporate tax and value-added tax is corporate tax is a direct tax, value-added tax is an indirect tax. What this essentially means is that corporate tax is levied directly on a person. Now, you could have a natural person like myself, yourselves, or you could have a legal person such as a company. Now, corporate tax is levied directly on the company on its income. Whereas value-added tax, although ultimately is paid by someone, a person, but it's not levied on a particular person. It's levied on a transaction, which is a supply of goods and services. So indirectly, it's imposed on an individual, but not directly. And that's why it's called an indirect tax. Now, in terms of when will corporate tax apply? It's going to be effective for financial years starting on 1 June 2023 onwards. Most companies' financial year starts on the 1st of January. So the expectation is for most companies, it'll be effective from 1 January 2024. So for those companies who have a financial year starting on 1 June 2023, the first reportable period will be from 1 June 2023 to 31st May of the following year. Whereas if your financial year starts on the 1st of January 2024, the first reportable period will be the calendar year 2024. Who does corporate tax apply to? It applies to legal persons and also individuals who are carrying on a business and commercial activities under trade and commercial license here in the UAE. Now, what does corporate tax cover? It actually applies to all industry sectors, so there's no exception, except businesses who are engaged in the oil and gas sector, the extraction of oil and gas. Historically, and even up until now, there's been two different types of taxes at the Emirates level. So one of them was the tax on oil and gas production companies, which is currently in place in 5 Emirates. And based on this announcement, it looks like the Emirates level tax will continue because such oil and gas companies will not be subject to the corporate tax law. There's also a separate tax decree which applies to branches of foreign banks. And it looks like that corporate tax will also apply to banks as well. So it's probably likely that the Emirates level tax may be abandoned. In terms of what the tax base is going to be of a company, the starting point is actually the profit in the financial statements. In terms of you start off with a net accounting profit, and then you make certain adjustments for tax purposes, and then you arrive at the taxable profit. Now, the net accounting profit is going to be the profit reported in the financial statements, which are prepared in accordance with international accounting standards. What's not clear in terms of how corporate tax will apply, the question is, will corporate tax apply on a residency basis? Because normally in certain countries, if you're considered resident in a country, you're taxed on a worldwide basis, and it's not clear whether the tax will apply on a worldwide basis or only on local source profits. And now, in terms of the definition of residency, this typically means that if you're incorporated in the UAE, you'll be considered resident here. And even if you're not incorporated here in the UAE, you'll be considered resident here if you're effectively or centrally managed and controlled here in the UAE. So if they do have a worldwide taxation and you're considered as a resident here because you're centrally managed and controlled here, the company's controlled here, although the company may be incorporated somewhere else, for example, the Cayman Islands, then you could potentially be taxable here in the UAE. I think the indications are that possibly there could be a worldwide taxation, although nothing has been confirmed at this stage. And the reason why I say possibly, because there is a foreign tax credit available, and I'll come on to that later on, which typically happens in worldwide tax systems. Also, for certain multinationals, I think they'll have to tax them on a worldwide basis, and so the effective tax rate is more than 15%. Otherwise, these companies could be taxed in other countries. And the third reason why potentially they could have a worldwide tax system is that some of UAE's tax treaties deny you the treaty benefits because you're not considered as resident if the UAE only taxes you based on source. So these are some of the reasons why the basis of the taxation could be worldwide. Also, what's relevant is the taxation of non-residents. As I mentioned, generally you'll be considered to be taxable here in the UAE if you're carrying on a business here under a trade or commercial license. It's not clear, for example, if you go beyond, if you don't have a commercial license and you somehow carry on a business here. Now, internationally, there's a concept of a permanent establishment for tax purposes. And a permanent establishment is a fixed place of business through which you carry on a business. And you could also be considered as having a permanent establishment if you operate in the country through an agent who's dependent on you and who's accustomed to carry on your instructions and who signs off on your behalf. And otherwise, if you have an office, a branch, all these things are considered a permanent establishment. It's not clear whether such definition will be adopted, but my expectation is that it will. And effectively, if you have a license in the UAE, you'd be presumed to be taxable. But even if you don't have a license, potentially, if you have a permanent establishment, you'd be taxable. But obviously, this is all based on my expectation, and nothing has been announced at this stage. Now, in terms of individuals, what we know is that if individuals could also be subject to, I was going to say corporate income tax. Actually, it's not a corporate income tax. It can apply to individuals. So the correct term for it probably is a tax on businesses. It's an income tax on businesses, essentially, which could apply to a legal person, which is a company, or it could also apply to an individual if the individual carries on a business and has a trade license. But otherwise, if you're a foreign individual and you're not doing business here in the UAE, you shouldn't be taxable. and you'd only be considered as taxable if you're undertaking an activity on an ongoing and regular manner, according to the announcement. But this may essentially mean that if you have a permanent establishment here in the UAE. Now, what we know is that investment in real estate should not be taxable. So if an individual invests in real estate, provided that he's not required to obtain a license, there'll be no tax. Employment income, salaries, bonuses, none of this will be taxable. Of course, this is personal income tax, and here we're dealing with income tax which is imposed on businesses. Otherwise, investment income earned by individuals as well should not be taxable. So there should be no tax on dividends, capital gains, or other income generated by individuals from the shares of a company in an investment capacity. And also there will be, of course, no personal income tax, or there'll be no income tax on interest receipts from bank deposits. In terms of the exclusions and what's outside scope, as I mentioned earlier, non-residents, they be considered taxable here in the UAE if they carry on an activity in an ongoing and regular manner. And once the legislation is issued, we may see in more detail what this actually means. As I said, my personal expectation is non-residents will be taxable in the UAE to the extent they carry on a business in the UAE through a permanent establishment. It remains to be seen whether this will be linked with licensing and how, because it may be that the licensing requirements change. If you have a permanent establishment, then you're required to obtain a license. Non-residents, whether they're a company or an individual, they won't be taxed on their investment income. So the position is very much the same as individuals. So they shouldn't be taxed on dividends, capital gains, interest, or royalty income. In terms of withholding tax, what we know so far is that there'll be no withholding tax. For those who are not familiar with withholding tax, there's two ways non-residents are taxed in a particular country. One is that if they have a permanent establishment, if they have a presence in the country, they file a tax return. If they don't have a permanent presence and they generate money or income from the country, typically they're subjected to withholding tax. Withholding tax is a tax which applies at source. So whoever is paying you the income, they deduct it at the time of the payment and they remit it to the tax authority, and you have nothing further to do because they've released you from any tax obligations, because the compliance obligation is with actually the payer, not the recipient, the non-resident recipient. However, as I said, there shouldn't be any withholding tax, at least initially. I mean, it's possible in the future that may be introduced. But one of the reasons why there's no withholding tax, of course, because the UAE wants to be a very attractive investment jurisdiction, and that's why for now at least they don't want to subject non-residents who generate investment income from the UAE to tax. The tax rates, I mean, when the UAE decided to adopt corporate tax because of these BEPS Pillar 2 proposals, there was effectively three possibilities. One possibility was that it taxed everyone, at the minimum tax rate, which is fixed at 15% currently, or effectively it taxed only those who are affected by those BEPS Pillar 2 proposals. And then the third option was it had like a higher rate for those who are affected by the BEPS Pillar 2 proposals, and it had a standard rate for everyone else. And it also had almost, you could say, like a tax break for startup organizations. And that's the route they've adopted. Of course, selectively applying tax to only those who are affected by Pillar 2 would have raised some eyebrows, and of course tax also is a revenue generator, so it's good to have it generates revenue, and you could streamline things if you apply it more broadly, and that's the approach the UAE has taken. So as far as we know, there's going to be three tax rates. The standard tax rate, which will apply to everyone, will be 9%, and this will apply if you earn income above 375,000 dirhams, which is aligned with the VAT threshold for registration. If you generate income up to 375,000, it'll be subject to tax at the zero rate. So effectively, this is a relief for startup businesses or businesses who aren't generating a lot of revenue. What we know is that a different tax rate will apply to certain large multinationals who are subject to the Pillar 2 criteria. We haven't been told what that rate is. The expectation is that rate will be a minimum of 15%. It could be higher. And I guess we'll have to wait and see exactly what the rate is set at. A multinational is, of course, someone who operates in a number of countries through a foreign subsidiary, branch, or other form of presence. And a large multinational is one with consolidated global revenues of more than 750 million euros, which equates to roughly 3.1 billion dirhams. Now, the 15% rate, as I mentioned before, under the Pillar 2 proposals, it doesn't apply to everyone. It only applies to large multinationals, who are subject to the Pillar 2 criteria. Now, moving on to exemptions, reliefs, and tax deductions. There's going to be an exemption for dividends and capital gains. In other countries, this is called a participation exemption. So essentially, dividends and capital gains earned by UAE businesses from qualifying shareholdings will be exempt from corporate tax. And that's regardless of whether the shareholding is in the UAE or is from a foreign subsidiary. Now, what we don't know right now is what a qualifying shareholding is. And what we've seen from other countries, typically you need to own a minimum percentage in order for it to be a qualifying shareholding. And this usually is between 5% and 25%. There's also a requirement to hold this shareholding for a minimum number of period, usually 12 months to 24 months, based on what we've seen in other countries. And there's also other criteria as well, which may be adopted. I mean, one of them may be that effectively it's based on the amounts that have been invested. And another criteria is that the company in which you're invested in is either a trading company or holding company of a trading group. So it remains to be seen exactly what the criteria will be, but there will be this kind of exemption. And this, again, is aligned with the UAE trying to be a tax efficient holding jurisdiction. So this measure here, this exemption, facilitates this. Another common thing which exists in other tax jurisdictions is giving a tax credit for any foreign tax paid in other countries. So the UAE has also announced that any foreign corporate tax paid, there'll be credit available for this tax against the UAE taxable income. So essentially, if this income is being taxed in the UAE, and this typically happens, for example, where this income is being taxed in the UAE because the company is resident here, but this income is also considered as sourced in another country and subject to withholding tax in that country. And so the UAE company may suffer withholding tax in the other country, and if the UAE taxes on a worldwide basis, then this income will be taxable in the UAE as well. However, the tax which is paid overseas, you'll be allowed to deduct it against your tax liability here in the UAE. The important thing to know is that this tax credit is a unilateral tax relief, so it doesn't require a double tax treaty. This relief is available under the UAE domestic tax law. There's also going to be deductions available. At the moment, no information has been made available under what circumstances you could claim a tax deduction. But obviously, it's widely expected that any deduction, business cost which you've incurred should be deductible for tax purposes. But this isn't an automatic deduction for every business cost. You, of course, have to meet certain requirements. So the expense has to be wholly and exclusively for the purpose of your business. Typically, what we've seen in other countries in the region, it has to be incurred for the purpose of generating taxable income. So if it's incurred for generating exempt income or income which is not taxable, then you will not get a deduction. Also, it's important to keep documentation in place to support the fact that the expense has been incurred, and just to demonstrate the substance behind the expense as well. And this is typically required before deduction is available. There'll also be, typically what happens is that the starting point is the accounting net profit, and then there's certain things which are specifically disallowable for tax purposes. For example, a fine is typically disallowed. Also, private expenses will be disallowed as well, and also sometimes head office expenses. So you may allocate head office overheads to the UAE company here, and typically these are either a deduction is disallowed or the deduction is capped. There may also be circumstances where an expense is not strictly a business expense, but you can obtain a deduction. For example, a charitable donation. Now, the idea behind this would be to obviously incentivize you to make these payments, and therefore they may allow a deduction for charitable donations, but there may be some cap on the amount that you could donate. What we also know from the announcement is that there will be ability to carry forward tax losses. So any tax losses you've incurred can be carried forward and used to offset against the taxable profits in the future periods. Normally, there's restrictions on this. In some countries, they allow you to carry forward the losses indefinitely. In other countries, you could only carry them forward up to a maximum of a certain period. For example, 5 years. There's also other restrictions on losses as well. So for example, if there's a change in ownership of the company, and there's also a major change in the nature and conduct of the business of the company, then typically the tax losses are lost. Also, the losses are usually allowed to be carried forward against activity of the same nature. Of course, there hasn't been much detail made available, but we could expect to see some of these restrictions. In terms of some of the other exemptions which may be available, in terms of governments and sovereign wealth funds, because these are not affected by the BEPS 2 proposals, because there's a carve-out for them, it's probably likely that they'll be exempt from tax in the UAE or not taxable at all. One other area which is interesting is how will the UAE tax companies which are owned by UAE nationals and GCC nationals. What we've seen in some of the other countries across the region, like for example Qatar, Saudi and Kuwait, that effectively the profit share of the company related to the local and GCC ownership is exempt from tax. However, if they do introduce such an exemption, and we're not sure at this stage whether there will be such an exemption, there'll probably be a carve-out for multinational corporations which are subject to the BEPS Pillar 2 proposals. Because otherwise, if there was an exemption, these companies could be taxed in other countries. Free zones is a very, very hot topic. Of course, free zones are a very important pillar of the UAE economy. There's different types of free zones. There's a number of free zones across the UAE. So you have some federal free zones like the DIFC, for example, and the ADGM. You also have Emirates level free zones across all different Emirates. Now, strictly speaking, if there was no specific rules for free zones, a federal tax law overrides the Emirates tax law. So although under the Emirates tax law, there's a tax exemption available if you operate within the free zone. If a federal corporate tax is introduced, federal corporate tax will override the Emirates level exemption, unless there's specific rules made available for free zones. Now, in terms of the federal free zones, of course, they're also introduced under federal legislation, so they have the same standing. So it just depends on what the specific rules are going to be for free zones in the legislation. What we know from the announcement is that free zones will be subject to corporate tax. I had a client contact me who was really worried, and when he read this in an Arabic article that free zones are subject to corporate tax. This doesn't mean that if a company is established in a free zone, it'll have tax to pay. It essentially means that all the companies in free zones will be required to file tax returns. Now, what we know, and as I said, free zones are very important for the UAE economy. So the announcement has made it clear that any benefits and tax holidays which are in free zones will be preserved. But this isn't a blanket exemption. It's going to be subject to certain limitations. So if you're a free zone company and you comply with all the regulatory requirements and you don't conduct business in the mainland, then you'll continue to benefit from the tax holidays. One other thing which is clear is that all free zones will be treated equally, and they'll all be subject to corporate tax in the same way. So there won't be a distinction, as is for VAT, between designated zones and non-designated zones. The primary purpose of that was to align the VAT rules with the customs rules, and that has no relevance or application for corporate tax. So that's why we're not likely to, we're not going to see a difference between different free zones. In terms of what's not clear, in terms of some of the things which are interesting is how would transactions between companies from one free zone to another free zone work? How will transactions between a company in a free zone and non-residents work? Our expectation is that these probably will benefit from the exemption, provided that you comply with the regulatory requirements in the free zone. And of course, these shouldn't constitute doing business in the UAE mainland. Some of the uncertainties are, what does it mean in terms of when are you conducting business with the UAE mainland and when are you not? So this question is subject to debate. And some of the interesting transactions are, for example, in the case of services, if you're a free zone company and you have customers in the UAE mainland, or otherwise you're attending meetings in the mainland, will that be considered as doing business in the UAE mainland? My expectation is it probably will. Also, perhaps it might make you non-compliant with the licensing requirements, because typically if you have a license, it's focused on you doing activities within the free zone. So if you do have customers, especially for services, it may go beyond that. In terms of goods, if you're selling goods to the mainland, how will that work? And again, this is one of those uncertain areas. I know that it depends. It'll probably depend on your license. Does your license allow you to do that? And whether this will be considered as doing business with the UAE mainland. Typically, if you're a non-resident and you're selling goods to the UAE, that's not considered as doing business in the UAE. So it'll be interesting to see whether the same approach will be followed for free zones. Of course, if it's not, then free zones will have a different standing to non-residents. So yeah, it remains to be seen how things will work. Another interesting area when it comes to free zones is how would it work where you have a free zone company which has activities in the mainland and also has activities in the free zone. Will effectively the income it earns from the free zone be tainted because it has activities in the mainland and is considered as doing business in the mainland? My expectation is that any income you generate which doesn't constitute you doing business with the UAE mainland and which complies with your regulatory requirements, that should be protected. So that shouldn't be taxable, and only the income which is generated through doing business in the mainland will be taxable. But again, this is my expectation. Things could work out differently. Generally, also, I think it's not very clear at this stage what's involved in doing business with the mainland, and it remains to be seen, how that's going to be defined. In the case of large multinationals who operate in the free zones, it's very uncertain. On the one hand, you have tax holidays and exemptions in the free zones, but on the other hand, you have these rules under the BEPS Pillar 2, which effectively will result in taxation for large multinationals who have global consolidated revenues of more than 750 million euros. They'll subject their profits to tax in other countries. So there is an incentive for UAE to tax large multinationals, even though they're operating in the free zone, because this income will be taxed in any event in another country. And of course, from the UAE's perspective, they'd rather generate the revenue from this income than allow another country to tax it. So there may be possibly a carve out for large multinationals. There'll also be a concept of tax grouping. We have tax groups for VAT purposes, and this is somewhat similar, but it will also be different as well. In order for you, if you're a tax group, you can actually elect to form a tax group, and the consequence will be you'd be treated as a single taxable person if certain conditions are met. We don't know what those conditions are. If you are a tax group, it means that the whole group can file a single tax return for the entire group. There's also a concept of group relief as well. So any companies within a group who have suffered tax losses could surrender these tax losses to another company within the same group who's making profits. So effectively, you offset your losses against the profits of another company in the same group. So on a group-wide basis, you could benefit from losses of other subsidiaries in the same group. There'll also be intergroup relief available for transactions within a group. And what's been announced is that it'll effectively be qualifying intergroup transactions and reorganizations. We don't know what this means yet, and no detail has been made available. But typically, this relief applies to transfers of assets within a group. And normally you would have capital gains applying to these transactions, but because of this relief, the transactions are considered to be undertaken on a no gain, no loss basis, and therefore there's no capital gains or there's no income tax on the capital gains because there's no capital gain as a result of these transactions. What we've seen from other countries, there are normally conditions attached to this. So normally you have to be within the same group, and a group is sometimes defined at the UAE level. So if you have foreign companies who are you're only a group because of foreign companies, then you may not be considered a group. Generally speaking, so far we don't know what will constitute a group. In other countries, we've seen it just means simply control, so ownership of more than 51% shares. Sometimes it involves voting rights of more than 51%, assets on winding up, income on distribution. So all these things are normally taken into account. In other countries, the level is up to 75% as well. So it could be just control, or it could be different. It could be 75%. And also you could possibly have a different group for different purposes. So when it comes to groups, you could potentially have three types of groups: one for purposes of consolidation, another one for the purpose of group relief, and another definition of a group for the purpose of this intergroup transaction relief. One interesting question is, can you form a group between a free zone company and a mainland company? That remains to be seen, but probably that would only possibly happen where the free zone company is taxable. Otherwise, it wouldn't make too much sense. Of course, there'll be compliance requirements as well once corporate tax is introduced. So businesses will be required to register for corporate tax purposes. They'll also be required to file corporate tax returns. Unlike VAT returns, which are filed on a periodic basis, which is typically monthly or quarterly, depending on the size of your organization, corporate tax returns are filed only once annually. So for the first financial year, you probably file a tax return within a certain period of the end of that financial year. In the region, we see typically that tax returns need to be filed, and the tax also needs to be paid within 3 to 6 months after the end of the financial year. So for a company which has a financial year starting on 1 January 2024, the first tax return will be due in possibly the first or second quarter of 2025. And the tax will be paid on the same day, likely. The tax returns and registration are probably going to happen electronically in the same way as VAT. We also know that there's going to be no advance payments for corporate tax. There's going to be a very, very simple system where you file the return and you pay the tax once at the same time. Of course, there's going to be a penalty regime, which will kick in for non-compliance with the corporation tax regime. We already have some penalties which are generally applicable across all taxes, and there's some specific penalties applicable for value-added tax and excise tax. So you can expect the tax procedures, regulations, or cabinet decisions to be updated to reflect the penalties for corporate tax. One final thing, I've already touched on the fact that, in terms of you preparing financial statements, they're going to have to be prepared based on international accounting standards. And it'll also be likely that your financial statements will be required to be audited, but that no details been made available so far. We of course had the economic substance regulations issued a few years ago, and the primary reason for the introduction was because there was some pressure from the EU, because they were trying to tackle tax avoidance where companies were setting up in jurisdictions with low or no tax without any substance. So the UAE, in order to be removed from the blacklisting and also in line generally with its commitments as a PEP's inclusive member, introduced these substance regulations, which require you to maintain a minimum level of substance in the UAE. And one of the main reasons why these substance regulations were there were because there was no federal corporate tax. But now that federal corporate tax will be introduced, it's possible that effectively the economic substance regulations are phased out. Transfer pricing is also very, very important. For those of you that don't know what transfer pricing is, effectively it's relevant for related party transactions. Of course, if you're related to a party, you can manipulate the price of the transaction. You could increase your expense. You could reduce your income so as to reduce your tax liability and pay less tax. On the contrary, if you're not related, then in those circumstances, you cannot manipulate the price. So these transfer pricing rules exist in a situation where the parties are related, and it requires you to effectively conduct the transaction on arm's length terms, which means that the price should be the same price as the price which would be agreed between the parties if they were not related. Businesses also need to comply with they're going to need to comply with these transfer pricing rules. So make sure that arm's length consideration is agreed between the parties if they're related, and documentation is kept to support the arm's length nature of the arrangement. So you'll have to review your intercompany transactions. You'll have to document the arm's length nature, typically through a master file, local file. And in terms of whether the transfer pricing rules will be domestic or cross-border only, they're likely to be domestic because, of course, we have free zones, and some of the income in the free zones will not be taxable. So there can be an incentive to allocate the profit to free zones. So therefore, I expect the transfer pricing rules to also apply to domestic transactions. But this is something that companies have not had to think about historically, because there's no federal corporate tax. But now that corporate tax is being introduced, the UAE will need to protect its tax base and effectively have transfer pricing rules. Now, just very quickly, because we just have 11 minutes left, so I'm just going to run over some of the key lessons learned and in terms of what you should do next. I think some of the key lessons learned was effectively, in terms of taxes being introduced across the region, whether that's corporate tax or value-added tax, is that companies at the beginning, because the tax is very, very new, they don't have a clear understanding of the legislation. And of course, corporate tax is coming in for the very, very first time. So there's likely to be a lack of clarity, at least initially. And therefore, it results in the adoption of incorrect tax positions, which could result in tax exposure. Also, a lot of companies, what they do is they wait for the final rules to be issued, and they leave their preparation very, very late. In some cases, the legislation could be introduced very, very late as well. I've seen some countries in the region which have introduced tax retrospectively. I've seen some cases where corporate tax was introduced, or a new corporate tax was introduced with less than 1 month notice. So that gives you very little time to actually adapt. So the key message is to actually be proactive and start doing some work now. And then obviously you could elaborate on that once the legislation is issued. But what's not advisable is to wait for the final rules to be issued, because it may leave very little time for you to prepare. Of course, corporate tax is a major change, and it's going to impact the whole of your business. Also, a lot of people think tax authorities, their role is to advise you on the tax implications. Their role is to provide guidance only, so they're not going to advise you. That's what tax advisors are there for. And tax authorities obviously have very limited resources, and they're not able to deal with everything, and it takes some time to adapt. Also, lack of training in-house, that's also a key area, which is a lesson learned historically, and it could affect your business, and all of these in combination could create tax risks and tax exposure. So you need to prepare. These are some of the things that businesses can do in order to prepare. So initially, and I'll quickly run over this, even before the legislation is issued, you could do initial impact assessment, looking at your current legal structure, your historical agreements, your business model. You may have done transactions historically which will have major tax implications going forward, and they didn't take into account tax at the time they were done. So therefore, you need to start the work now and at least do an initial impact assessment to see how you'll be affected. Once the legislation is issued, you could do a more detailed impact assessment and validate some of the assumptions you're making now. And then later on, before the law is implemented, you may need to do reorganization. You may need to restructure your business, and there's some action points which will arise from your impact and detailed assessment, which you need to undertake before the law comes into force. Obviously, once the law is in force, then you need to comply by registering, filing tax returns, paying tax, complying with all the obligations, including transfer pricing, and then going forward, there'll be disputes. As a law firm, we deal with all these areas. Obviously, you'll receive a copy of the slides, so you could have a look at this in your own time. So I'll just quickly move over to questions and answers, and I'll try to respond to as many questions as I can. And in the event that I'm able to, I'll try to respond by email. So just going through the questions. There's a question here. Just trying to open this up. Okay. What type of expenses do you think will not be allowed for tax purposes? I touched on this. Essentially, expenses which are not business expenses, so expenses which are private expenses, and also there'll be certain expenses which are specifically disallowed. For example, fines. If you've incurred an expense for something illegal, that will also be disallowed. I think that the disallowables will be very limited. So generally, if you satisfy the general criteria, which is that the expense you've incurred is for business purposes and for the purpose of generating taxable income, and you could support that, then it should be deductible, unless the expense is specifically disallowed. And I expect those circumstances to be very limited. What if the company earns dividend or corporate dividends non-taxable? Yes, I mean, according to the announcement, effectively, if you earn a dividend and you have a participation, a qualifying shareholding in the company, there'll be an exemption. Of course, as I mentioned, that we don't know what a qualifying shareholding means at this stage. In terms of non-residents and individuals, earning income from dividends, that should not be taxable. Is there any special rulings for aviation industry? There's no rulings for the special rulings or special rules for the aviation industry as far as we understand it right now. Of course, the announcement was very provisional and further detail will be made available. Are free zones confirmed to be exempt by corporate income tax? As I mentioned, this exemption is not a blanket exemption. It's an exemption which will be respected if you respect the rules. So provided you act within the scope of your license, you comply with the requirements of the free zone, and you don't do business with the mainland. And like I said, we don't know what that means at this stage, and further detail will be available. Under those circumstances, you could expect the exemption in your free zone to be respected. Threshold for registration. Top line revenue arising from business transactions. There's no threshold for registration as such. As I said, profits up to 375,000 dirhams will be subject to a 0% tax rate. It's possible that even if you're subject to the zero tax rate, you still may be required to register for corporate tax purposes. It may be that everyone is required to register. Every company is required to register if they do business in the UAE. for corporate tax, but not all of them pay tax. And so that remains to be seen. There may be an exemption for registration from very, very small businesses. We're just going to have to wait and see. I think another question which is regularly asked is that how will non-residents be taxed? And as I mentioned, non-residents will not be taxed in the UAE unless they're doing business in the UAE. And we've already been told that they'll be considered as doing business in the UAE. So there's a presumption of doing business if they have a license to operate in the UAE. Otherwise, even if they don't have a license, possibly they may still be taxed if they're effectively doing a business in the UAE through a permanent establishment. Another question which is typically asked as well is that how will the taxation work in terms of different emirates? Now, this is going to be a federal level tax. It's not an Emirates level tax, unlike the corporate tax, which is there. So it's a federal level tax, so you'll be taxed at the federal level, regardless of which emirate you operate in. Now, in terms of is there going to be an allocation, obviously we'll find out when the rules are issued. There's a question here, does the definition of corporate include startups incorporated as establishments or exemptions likely to be made? I mean, at the moment, there's no definition of corporate. Of course, the legislation hasn't been issued as well. I think that if you're an establishment and you're licensed to operate in the UAE as a business, then you'll be taxable in the UAE. There'll be no exemption available by reference to the fact that you're an establishment. So as I said, normally an establishment is an individual who operates the business in his own name and he doesn't have a limited liability. And in that situation, as I mentioned earlier, you'd be subject to tax if you're licensed to operate in the UAE. There's a question here, does rental income from properties will be taxable? If you carry on a rental business, if you carry on a real estate business where you're receiving rental income, then you'll be taxable. And as I said, it's not clear right now whether you just owning property and earning rents from it will be considered as doing business. And further, if you as a free zone company own real estate and you generate rents, if you have one property, will that be considered as doing business? I think what was announced was that if you're effectively a corporate, there'll be a presumption that you're doing business. If you generate rental income. I think our time is now up. I appreciate everyone attending today's webinar, and for any questions that I haven't been able to answer, I'll endeavor to get back to you through email. Thank you very much for joining the webinar, and we will make slides available as well as recording of the webinar. Thank you, everyone.